So how do you know you're buying the right property at the right price? Welcome back to Confident Real Estate. I'm your host, JC. We've already determined how to find the right market to invest in. And if you haven't watched the video that we did about where to buy and how to make sure the market you're buying in has the right fundamentals and infrastructure to be a solid investment for long-term success, then you really need to watch that video right after you finish watching this one. And you should probably hit subscribe down below so you're not missing all of the great content we keep putting out. Today, we're going to look at making sure you're buying the right investment in that target market. So we're going to review in this video what type of property you should be buying, the type of rents you should expect to receive from that property, the purchase price you should be paying for the right property, and the after repair value that the property is going to be worth after you've done some basic renovations to the property. And lastly, we're going to look at making sure you have the confidence to know that you're doing all of these calculations correctly, because that's obviously quite important. And in return for sharing all this information, the only thing I want from you is to please hit the like button. And now we can get on with the video. Let's get into it. As we've reviewed in other videos, it's important to understand what makes the target market you're investing in work, and why are people choosing to live there versus somewhere else? Is it the schools? Is it the employment opportunities? Is it the access to highways or the major infrastructure of public transportation that's so beneficial? Is it shopping? Is it some other reason? Is it access and accessibility to a local airport? You should know what the answer to those questions are, and it should be a combination of factors. It shouldn't be just one, because you don't want one thing to change in the marketplace and then suddenly the entire neighborhood you invested in is no longer desirable and people are moving out. That's not a good situation. Think Detroit and the auto industry. The jobs left, and then so did the people. And I think we all know how that ended up after that. Are the majority of renters in your target area young families or young professionals right out of college, or is it a college town? Are they retirees who are really looking at renting in that area because of the plethora of opportunities for playing golf and laying out in warm weather while they play shuffleboard? It's important to know. These factors will determine whether you should be investing in a single-family residence or a multifamily property with certain layout combinations, like a 2-bedroom, 1-bath, or a 3-bedroom, 2-bath minimum. Maybe it's a college town or a town filled with young professionals who are looking for their first place out of college or off-campus housing because they're still in college, and you can get away with 1-bedroom and studio combinations. Is in-unit laundry something that's paramount to your renters, or is accessibility to a nearby laundromat acceptable? Do you need to have on-site parking, or are the majority of the renters in the area using public transportation because there's a great public transportation infrastructure? Next, you want to identify a few properties that fit your criteria and are in your price range. And then you want to run what are called comps, comparables. There are different types of comps. You want to prepare a set of rental comps that will determine the types of rent you should be receiving, and you want to prepare sales comps. And there are two different types of sales comps. There are the sales comps that will determine the purchase price you should be paying for the property that you've identified, and there's the after repair value comps that will determine what you should expect your property value to be based on renovations that the property requires. And that will also help you dictate how much you should be spending on those renovations. I would suggest you do the sales comps first, and there are certain metrics you want to use to compare recently sold properties to the property you've identified. And those are the square footage of the properties. You want to compare the age of the properties, how recently they were built, how old they are. You want to compare the unit layouts. Are they offering renters the same types of units, like a 2-bed, 2-bath, or are they offering completely different types of units? Are you comparing single-family residences to 3-family, multifamily properties? That's not comparable. You also want to compare the upgrades. are the properties that have recently sold, fully renovated and turnkey. Presumably, you're buying a property that requires at least a minimum renovation so you can get some equity appreciation on the after repair value after you've done your renovations. Anything you're comparing to that's already renovated would be a good comp for your after repair value determination, but not a good comp for your purchase price valuation determination. Again, you're running two different types of sales comps. Comps that show you what you should be paying as a purchase price, and comps that show you what your after repair value will be after you've done some renovations. Because again, we're presuming that you are going to buy something that's going to need at least a little bit of renovation work, because that's how you get better equity appreciation. You want to look at the amenities. Do the properties all offer in-unit laundry or on-site parking? Or is it a combination? Some do, some don't. Or do none of them offer it, because that's just not how properties are built in that area, and it's a city area where laundromats are every few blocks and most people take public transportation. But most importantly, you want to look at proximity. You do not want to compare your possible purchase property to properties that have closed and recently sold on the opposite side of town. That doesn't do you any good. It should be within 5-block radius of the property you've identified. Those are the properties that you want to compare your target property to, because they're all in that same general vicinity. You want to have at least 3 comparable properties, but the more the better. And they should all be within 6 to 12 months of the time that you're looking at your investment property. You don't want to compare your purchase price potential to a property that closed more than 12 months ago. Ideally, within a 6-month window from the time you're looking at the property, that's what you want to focus on. But if you cannot find a minimum of 3 properties that have sold within the general vicinity of your target property in the last 6 months, then maybe you'll start to stretch back to a 12-month period. Again, a minimum of 3, but the more the better. Do not have a realtor prepare your comps for you. They make their money on commissions based on how high the property sells for. So they want it to sell for more than you want to pay for it. You either want to sit down with the realtor and do the comps with them, since they have access to the general system that shows all the properties that have closed recently, or you want to do your own due diligence and go do that legwork yourself by looking up in the local Department of Buildings or the local town hall what's closed recently and look in a general area. You could probably also find it on a lot of websites like realtor.com and other sites. They'll give you properties that they've listed as closed in the last 6 months, and they'll show you on a map that they're in the general vicinity of your target property, and then you can go follow up to verify that information. You could also get the comps from a realtor and then compare their comps to your comps to see what's realistic, and that'll also tell you how knowledgeable and trustworthy the realtor is. But again, don't just take what the realtor gives you as facts and comps. You want your comparable market analysis, but you want to make sure you have done the legwork to make sure it is correct. By comparing these sold properties against the listing prices of the properties that you're targeting as potential purchases for investment, you'll have a great understanding of what the price per square foot you should be paying really is. And again, if you're buying properties that need a little bit of renovation work and you've looked at comps of fully remodeled properties, that'll give you an understanding of what the after repair value of those properties will be when you've done the work after you bought the property. So you'll now have an understanding of the price per square foot to purchase a property, what's reasonable, and what's a reasonable price per square foot to believe you will have in after repair value after you've done the renovations. And that will tell you how much you can really spend on those renovations so that you don't overspend, because you're not going to spend $50 a square foot on renovations if your after repair value is only going to go up $20 a square foot. Next, you're going to do the same thing, but on the rental side. You're going to look at what properties are currently renting for. You're going to look at what people are asking for in rents, what those apartments and units that they're renting have. Are they 3-bedroom, 2-bath? How much square footage? What are the amenities? How old are they? Are they remodeled? And that will give you a sense and an understanding of what the rental value is on a property that you purchased that's a little dated and a little old, and what the rental value is on a property that's remodeled. So you will then know what you can expect on day one as rents and what you can expect as rental value after you've done renovations, because maybe you're not going to be in a position or confident yet enough to do the renovations as soon as you close. But you also may have a property that you buy that has people already in it with good leases, who have good credit, who are paying, and you don't want to push those people out. You want to take them on as your tenants, and then as the units turn over, you'll start renovating them one by one. So again, you're doing the sales comps on the purchase price, the sales comps on the after repair value, and your rental comps based on the property's condition on day one, and your rental comps on what the value of the property and will be after you do your renovations and what you can expect in rent for a renovated property. If you're not going to do the renovations for some time into the future, then you'll do the rental comp on a renovated property at that point in time. Next, in order to determine that you are doing the calculations correctly and to gain confidence in your ability to do the calculations, you need to hit the ground. Go out and look at the open houses, tour the properties that are available for rent, because that's how you're going to see how clean they are, whether or not there are some bugs on the ground, whether the landscaping is as neat as it looked in the pictures for the listing, whether there are creaky floors or quirky bedroom sizes that the pictures really glossed over. You have to actually visit the properties to get a sense of what's really being sold and rented at the values that you've determined based on the numbers. Numbers aren't going to tell you the intangibles that walking the properties themselves will actually reveal to you. And the very last thing you should do, which you should probably do before you do anything else that we discussed in this video, is hit that like button, and while you're at it, hit that subscribe button so that you don't miss any more of the content that we keep giving out for free that is hopefully very helpful to you. If you did find this information helpful, leave us a comment down below. If there's something else you want to learn or hear about, leave us a comment down below and let us know, and we will try to make a video to accommodate you, because that's what we're here for. We appreciate you watching. Go crunch some numbers, go buy some property, and continue to educate yourself and build that portfolio. Till next time.